We must have come across the term product life cycle, right? So a product goes through many stages. The initiation stage, then comes the growth stage, then the maturity stage, and the decline stage. So similarly, as in case of products, the companies also go through different stages, right? So one of the stage which comes up in many occasions is called the decline stage, or in other words, we may say that the company is really not working to the best of its ability, and that is why they are not being able to realize the money to be able to pay the financial institution back, right? So there may be many other reasons to it. They may have done some fraud, they may have taken the money outside the system. I'm not getting into that sort of a discussion, but let us assume that the situation is such that the company is really not doing great in its business, and they are not being able to pay back the money to the financial institution. So in that sort of a situation, what the company does is that they go to the financial institution with a report which speaks about their game plan for the upcoming years. So they go to the financial institution asking for some sort of support in terms of, say, uh, increasing the term of loan, or say increasing the moratorium period, or reduction of the interest rate, and so on, right? So when this company goes with that sort of a structure to the financial institution, the model that gets worked on is called a restructuring model. So I thought of just in taking you through the different sheets which are generally worked on in a restructuring model and expose you to that, right? So let's look into it. So the first sheet over here, but before I start on taking you through the different sheets, let me tell you that this is a general structure. You can always work on in any order or any structure that you want to do. It's not that you have to follow this structure, but then this is quite comprehensive a model, so I thought of showing this to you, right? So as you see, the first sheet is the sales assumption sheet, which speaks about the different assumptions in context of sales. So we see production capacity, the production which has actually happened, the sales, the adjustment in the sales entries that's been done, the percentage of sales in different in the export market, in the domestic market, and different broader heads of castings, machining, and all, right? So these are the different set of assumptions which are being taken in this sheet, and a small sensitivity analysis structure is also built into, right? So this is a typical sales assumption sheet, so which goes into many years, as you get to see. So for people who are new to the world of financial model, so this is quite a comprehensive model, as you understand, and it's going to a number of rows and number of sheets. So this is where the real interest in the work comes up, right? So this is the sales assumption sheet. I'm not going into how to build on a sheet in terms of its how the entire figure comes up, because that would entail a total program by itself. But here the objective is to expose you to those set of people who have never been exposed to a restructuring model, as to how a restructuring model looks like. And I always believe that if you know as to how the end product is, you still find a way or means to reach to that end destination, right? So if you don't know what exactly you are trying to reach to, you are always confused, right? So that is the purpose with which I intend to show different stuff around finance, so that one, it really gives you a sense that this is how the end product looks like, and the other is it gives you some sort of motivation to gain those knowledge and understanding which is required for you to gain uh, the skills that is going to help you build these end products, right? So that's the objective. So let's move into the next sheet, which is called the expense assumption sheet. So as I mentioned, it's not that you have to have separate sheets. You can have all the assumption in one sheet, but in if you're putting every assumption in one sheet, the challenge is it's very difficult to move throughout the calculation, and that's why people prefer to break it up into separate sheets and work on, right? So this speaks about the different set of raw metal that is required, right? And at what purchase price it's bought, and what is the purchase price in context of that, what are the costs in context of stores and spares, the unit consumption, labor cost, machining expense, other manufacturing expense, and stuff like that. So it gives a detailed analysis around that, right? So this is how a expense assumption sheet is built. Then comes the EBITDA sheet, so where uh, one gets to understand the different elements of revenues and expenses and the cost of production, and finally the EBITDA margin is reached, right? Then comes the working capital sheet. So working capital, as we understand, is the finance which is required by the company in order to run their daily operations. So the assessment in terms of the total current assets, the net working capital gap, the margins which is required, and finally what is the extent of bank borrowing in context of working capital that would be required. So for this set of calculations, different assumptions are taken. So one of those assumptions is the assumption of holding period, which you get to see. Then you also uh, get to analyze the letter of credit, because that also gets to be important if you have purchases of raw materials both in inland as well as on a international basis, right? So this shows you the working capital sheet. Then comes the restructured debt schedule. So as I mentioned that the company which is looking for some sort of a relief, they come up with a timeline or propose some sort of a timeline, which is then assessed by the financial institution whether that can really be done. So over here, say the restructuring tenure is being said to be this 10 years, where they're looking for 2 years of moratorium period, post which they would start repaying for this number of periods, and the accounting year is this. So there are different nature of loans that they have taken, and the interest rate they are proposing in context of that, and the percentages. So the total comes to 100%, as you see. So they would make 2.5% payment of, say, working capital term loan in 2014-15, 5% in 15-16, 7.5% 16-17, and also it total adds up to 100%. So there are different nature of loans. I'm not getting into that sort of a discussion. I'll discuss it some other day. What is WCTL, what is FITL, and things like that. Here the purpose is to just give you an exposure as to how a restructuring model looks like, right? So then comes the restructured debt payment. So basically, once you understand what are the assumptions that's been taken, then which are the different banks, what are their present debt profile, what has been the sanction amount, what is the amount which is outstanding, right? And what are the timelines they intend to pay, and in that context, what is the amount that is going to be paid over a period of time, right? So for the different nature of facilities, when I say facility, I mean to say the different nature of uh, financial means say the working capital term loan, FITL, term loan, working capital. These are all facilities which are enjoyed by the company, right? So how they are going to make those payments. So this is the entire structure, as you get to see. This is the capex funding and stuff like that, right? Then comes the income statement. So essentially what it means to say that post this sort of a structure gets approved, then how the entire financing cost would look like, and how the entire uh, profit and loss statement or the income statement would pan up, right? So this is what is getting reflected over here. Then comes the balance sheet, the different sections of the balance sheet, and then the cash flow statement, the normal set of financial sheets which has to be worked on, right, with the assumptions that has been considered. Then the sheet around depreciation show, so whenever you are doing the financial statement calculation, there would be certain figures which would be coming up. One of them is depreciation. Then comes the income tax section, sorry, then you have income tax calculation over here. Then you have the drawing power calculation. Drawing power is essentially what's the extent of money which is already blocked in context of raw material and work in progress and spare parts, right? And what is the amount that can that is is a shortfall on the present working capital which has already been sanctioned. So what is the extent that can still be realized? That is what drawing power helps in calculating. Then the different calculations around financial ratios that you get to see are all calculated over here. Cash break even, loan life ratio, internal rate of return, DSCR, adjusted DSCR, and stuff like that. So different set of ratio calculations gets done. Over here we get to see the DSCR calculation. The DSCR, as we understand, is debt service coverage ratio. So it's a very important piece of financial calculation which is looked after by the financial institutions to get a sense that whether they are safe in order of realizing the money which they have extended to the company. So one is DSCR, which is calculated on the basis of PAT and depreciation, right? And the other is adjusted DSCR. This is another calculation which is as you see over here, is on the basis of available cash flow, right? So this is how it's different. I'll someday mention about the difference between the calculation of DSCR, adjusted DSCR, in some other video. And then comes the financial covenants in terms of the if the RBI and all has mandated that these are the ratios that needs to be calculated, and they have given a structure on that, how the computation should happen. So all those are calculated over here. And finally comes the break-even point computation, right? So this gives you in a brief sense as to how a restructuring model look like. And with the in the present context, there are a lot of NPAs that are there in the debt market, and there is a lot of work that's is presently happening in context of restructuring and turnaround, right? So I think this understanding is definitely going to give you some insight, and is going to generate that curiosity of learning it further. So I'll take the discussions further in some other videos, but here the objective was just to give you a glimpse as to how a restructuring model looks like, right? So I hope it added some value to you. If you liked it, give a like, share, subscribe, and press the bell icon if you want these videos to be reaching out to you as soon as we post it, right? So see you in some other video. Thanks a lot.